Hi everyone, what are you doing? Hope you're doing well. Welcome to our video. It's time for another stock analysis update here on this channel. Today we'll be talking about Intel. A few months ago I already made a full detailed analysis of this company in specific, so this time it's going to be just a small update. I'm going to show you my discounted free cash flow Excel spreadsheet. Going to show you my assumptions and what is the fair value for this stock according to my own analysis. As always, this is not financial advice. Just because an investment might make sense for me, it might necessarily be the best one for you. We all have different risk tolerances, we all make different assumptions, and just bear everything that I say with a grain of salt. I'm also making this video because I recently started a new playlist here on my YouTube channel where I'm starting a new investment portfolio, a public investment portfolio from scratch. And I want to be fully transparent, and each month I'm going to contribute a symbolic amount, a small amount, just to prove that anyone can start nice and slow and easy. The bulk of that portfolio right now is going to be ETFs because I'm still building the foundation, so 75% of the portfolio is going to be ETFs and the other 25% is going to be stocks that I pick. But I don't want those episodes to be super long, so I'll make separate. Since I'm going to be in this next month or today, this month is in specific February, I'm going to be investing in individual stocks. One of them it might be Intel. I'm going to make separate videos where I go more in depth about why I'm buying and why I think it's a good price, because I don't want those public stock portfolio updates to be 1 hour long videos. Having that said, let's jump into the laptop. As you can see, from the price fluctuations, Intel recently plummeted about 16%. Right now it's rebounding a bit to $48 per share. But as you might know me, I'm not an expert in technical analysis, so I'm not going to be drawing here moving averages. If you want to do that, that's fine, but the goal for investing, at least for me, is long term. I just want to build a portfolio slowly and compound my net worth, and hopefully one day I can look back and think that I make good decisions, or maybe not, but at least I'll have these video logs that I can rewatch and understand why I was buying specific companies at specific prices. And sorry, I don't know what's happening to my voice today. And we have here Intel spreadsheet, ticker symbol INTC, and we have here the analysis, the historical data from the previous 5 years, 2017 to 2021. They say Intel is a dying company, but as you can see, revenue is still growing. Of course, we have other competitors, and if you want to know more about this, I recommend you watching my previous video that I made a few months ago. I'll leave the link in the description because I go more in depth talking about the competitors and why I don't think they are such a good opportunity like Intel, because I want to buy good companies at good prices. I can have the most amazing company, but if it's trading too high, it's super overvalued, you will not have that big of return. But let's pick up a small company that produces these pens. If I know, it might not be a super interesting company, but if I know for sure that they will be growing their revenue 100% each year, I would of course I would dump all of my money into that company. But investing is all about making assumptions, and you cannot forecast all the scenarios. It's a matter of probability. So even though I'm showing you this analysis, this can be flawed, and that's why such a large chunk of my public portfolio is going straight to ETFs, so you are more diversified into a basket of goods. Of course, I wanted to just invest into the companies that I perceive to be undervalued, but my analysis might be flawed. I might not have access to all the information, or I might be, and you're just putting all of your eggs in one basket if you invest into one single stock. And that's why even one single share or one single stock of a company, and that's why it pains me to be investing in such diversified ETFs in the beginning, but it's the correct thing to do, and I want everyone to follow along. And I always assume that I might be wrong in my own analysis. Not a good way to live, but it has its benefits. We have here some averages. For example, the revenue growth for a so-called dead company has been 6% over the last 5 years. You can see that they have an healthy profit net income margin of 25%. Of course, this can lower in the future as more competitors gain more market share. But the ship industry, we're going to be needing a lot of ships. So if the market share, the market quota is expanding itself, even if we have a smaller pie, since the whole pie is bigger, you might not see such a huge difference in net income terms, even if they lose some market share to other competitors. I don't know if the audio is going to be good in this video. My voice is really low, and I just wrote here on the side, so I assume no growth for 2022 and 2023, and I'm going to assume the same amount of shares outstanding. What am I saying here? Essentially, you can see that the revenue for Intel in 2021 was $79 billion, and I assume that in 2022, this year, it's going to be 78, and in 2023, 79. More or less the same, so no growth at all. And only after 2024, 2025, 2026, they will be growing, and this is going to be the normal case scenario at 2%. In the first 3 years, you can see here from 2023 to 2025, and then only 1% from 2025 onwards to 2028. Essentially, this is quite conservative, and as you know, the company total value, they divide each investor. Let's suppose you're investing in one share. One company has 100 shares. If you have one share, you have 1% of the company. Intel has been decreasing the amount of shares, so they've been buying back those shares, and I assume they will stay the same, for in this case 4 billion shares. I'm also assuming a rate of return of 10% and a perpetual growth. That means that after this year, that company will grow at that rate, and a rate of return of 10%, because that's been essentially the average for the S&P 500. So I want to have at least 10%. Of course, let's suppose in the scenario that in the future interest rates rise exponentially, and you can get 10% from, let's say, a bank deposit somewhere, or by holding treasury yields. Of course, I would sell all my stocks and go for a less risky investment such as stocks. But in the current conditions, this makes sense, or at least these are my assumptions. For the normal case scenario, and I assume the 23% margin, even though the average from the last 5 years is 25. It gives us a fair value of $47 per share. And of course, we have these conservative assumptions, no growth for the next 2 years, and only 2% and 1% onwards. And why am I only growing after 2024? Well, recently Intel announced, it's been a few months, that they are building a new chip factory, and it will only be ready around that date. So I'm assuming no growth until then. You can do your own assumptions. This is just me sharing what I think. Of course, I made a bullish case scenario. I still assume no growth in the next 2 years, but I increased the margins for the company 25%, and this gives us a fair value of $54. And in the worst case scenario, gives us a scenario of $43 per share. And I just want to point out that I'm not changing any shares outstanding. Let's suppose this goes from 4.09 to 3.9 shares in, let's say, in 2029. You can see that the fair value automatically boosts, because you'll be dividing the company value essentially for less shares. And you can see here, you assign probabilities, and you get a 47.9. Dollars per share, and right now it's trading, oops, sorry for advertising, and you can see here that right now it's trading around that value. And I'm making, some people like to give some margin of safety when they are doing their own analysis. I like to make really conservative assumptions. I think this is a future where it will be like, it's conservative assumption, so I think Intel can pull this off. Of course, if I just make if I make crazy assumptions like they are going to grow, let's say 10% or 5%, of course this is going to change everything. Let's say what would happen if that was the scenario. Values. So you can see here that the shares, but Do I believe that this company can grow at these rates? No. But then again, this is all about the narrative that people will talking. That's why there's so much speculation. If you believe a company is going to be growing 20%, 30%, of course, stock prices are going to rise because everyone is perceiving. Then again, when those companies release those earning reports and it doesn't match the expectations of analysts and the public in general, of course, those companies will be plummeting down. At least that's how markets should work. Okay, everything is fine. And yes, that was essentially what I wanted to share for this video. I still need to make videos for the other companies that I'm planning to invest in this month. So stay tuned for this channel. Sorry for my voice today. I don't know what's happening, and I'll see you in the next video. Bye.